Look, to be fair and honest, last 2 years have not been easy in investing in China. We have had so many negative headlines. We had so many negative press, negative media. Obviously, the country went through its own slowdown, is continuing to go through its own slowdown, which bring its own challenges when investments. One of the biggest contributor to the GDP, directly, indirectly, China property has not done well. And that's a conscious decision by the government, but really it's not done well, right? There is a very big element of deleveraging, de-risking the China economy, which the government is doing. They started this with 3 red lines. Sorry, not many people read much into it, but it actually gave the results which probably the government wanted and government is still looking for. And with that kind of a backdrop, and I invest in US dollar assets, China property is probably one of the bigger, or was one of the bigger component of that market. So seeing so many restructuring, defaults, pain points, pressure points, it does not help. And that actually leads to a negative feedback or a negative loop on the entire country. But that doesn't mean that China does not have its own set of opportunities. You need to actually pivot. You need to see what are the opportunities that the country is actually offering right now. We have actually been one of the most vocal supporters of China POEs in the TMT space. We did believe that some of the headline noises had ended last year. Again, that sector saw its own headline noises starting from Jack Ma. But again, those things actually are in the back seat right now. And they have some of the best businesses in the POE sector in the TMT. So there is a good set of opportunity over there. Now, we are also very forward-looking kind of investors, and that's what we are paid for. And when you look at the forward-looking opportunities in China, you have to understand that the country is actually pivoting away from being too over-reliant on infrastructure, too reliant on property, and that's not what they're going to use as a re-leveraging. They're focused on good quality growth, which is going to come from exports and consumption. So then what are the sectors that we are ideally actually looking at? There is a big space called EV, battery storage, semiconductors, where it's a small player, but it actually wants to be a big player. So these are some of the opportunities which we are looking for. Hopefully we will get an opportunity to invest in them at some point of time. The ancillary industries of these sectors, there will be good opportunities. But yes, what last 2 years also has also taught that we need a more risk premium on, or an elevated risk premium on China. And as investors, we cannot complain. And that's what we are actually getting at this point of time. I also make this point, and I want to be very clear. Look, Asia, in terms of the fixed income market or credit market, is a relatively very new market. We have been here for like 15, 16 years. Every asset class goes through its own cycle. This is the first credit cycle, or a first proper credit cycle Asia has seen, and China is doing that. So there will be pressure. There will be more volatility within that space, but there are definitely opportunities also at that point, at the same point of time. And we need to see through the noise. We need to see through the negative, noise coming out or negative data coming out, and see where the opportunity set lies. And that's our job.